A hunter named Grok kills a mammoth. Too much meat for one cave. Grok could eat until sick, watch the rest rot, and starve by next moon. Or Grok could store the meat in a shared cave and let 3 other hunters help guard it and keep it cold. In exchange, they each get a piece of every future mammoth Grok kills. And Grok thinks this is genius because now he has help and they have food. But here's what actually happened. Grok just invented a system where his survival depends on keeping 3 strangers happy. Those strangers now expect mammoth every moon whether Grok catches one or not, and the moment Grok has a bad hunt, everyone panics and the whole arrangement collapses. The meat sharing worked great until someone realized the real question wasn't how to split the mammoth. It was who owns the uncertainty. Stocks are the exact same deal, just with more paperwork and less mammoth blood. I'm going to explain this using the one thing your brain actually understands: meat. Because when you strip away the jargon and the CNBC graphics and the guys in suits yelling about the S&P 500, stocks are just formalized caveman meat-sharing agreements. And the reason most people don't understand stocks isn't because they're stupid. It's because Wall Street spent a century making it sound complicated so you'd pay someone to explain it to you. Here's the basic model. You're a hunter, you're good at killing deer, but you need a better spear. That spear costs 20 stones, you only have 5 stones. So you go to 3 other hunters in your tribe and you say, look, if you each give me 5 stones, I'll buy the spear, and every time I kill a deer with it, we split the meat 4 ways. They agree. Now you have 20 stones, you buy the spear, you start killing deer, and everyone gets meat. Congratulations, you just issued stock. Those 3 hunters own 25% of your hunting operation each. You kept 25%. The deer meat you give them is dividends. The spear is capital. The 4 of you together are shareholders. This system works perfectly until one of the shareholders realizes something. He doesn't actually want the meat right now. He's already got meat. What he wants is to sell his share to someone else. Maybe there's a younger hunter who's hungry and has stones but no shares. So they make a deal. The original shareholder sells his 25% stake for 7 stones. Why 7? Because the young hunter thinks you're going to kill even more deer in the future. So that share will be worth more than the 5 stones it cost originally. And the original shareholder is fine with that because he just made a 2-stone profit without ever picking up a spear. You now have a stock market. People buying and selling shares based on what they think the deer hunting operation will do in the future. The price goes up when people think you're going to kill more deer. The price goes down when people think you're going to miss hunts. And notice something important here. You, the actual hunter with the actual spear, didn't get any of those 7 stones. That trade happened between 2 other people. You already got your money when you sold the original shares for 5 stones each. Everything after that is just people betting on your ability to keep killing deer. Now you might be thinking, okay, this makes sense for deer hunting, but how does this scale to something like Apple or Tesla? Same exact structure. A company needs money to build something. iPhones, electric cars, whatever. They don't have enough cash, so they sell shares. You give them money, you get a piece of the company. If the company does well, your shares become more valuable because other people want in. If the company crashes, your shares become worthless because nobody wants a piece of a dying operation. The only difference between your deer hunting operation and Apple is that Apple has about 16.2 billion shares floating around instead of 4, and their deer is every iPhone sold in a fiscal quarter. So first, escalation. You, the hunter with the spear, realize you can just keep selling shares. You sold 4 shares to get your spear, but your hunting operation is doing great, deer everywhere. So you decide to raise more money to buy a second spear and hire another hunter to work for you. You create 4 more shares and sell those. Now there are 8 shares total, and you only own 1 of them. You just diluted yourself, and every existing shareholder now owns a smaller percentage of the operation. The young hunter who bought in at 7 stones, he's pissed. He thought he was getting 25% of infinite deer. Now he owns 12.5%. You just cut his ownership in half without asking. And this happens in real companies constantly. Stock-based compensation for employees, secondary offerings, convertible debt. Every time a company issues new shares, existing shareholders get diluted. The pie gets bigger, but their slice gets thinner. Second, escalation. People realize they don't need to wait for you to actually kill a deer to make money. They can just trade the shares back and forth based on rumors. A scout comes back and says he saw a huge herd of deer 2 valleys over. Your stock price doubles. Everyone thinks you're about to have the best hunting season ever. The herd turns out to be elk, and you can't kill elk with your spear. Stock price crashes. The actual meat production didn't change. You're still killing the same number of deer per week. But the stock price is swinging wildly because people are trading based on expectations, not reality. And here's the thing. That scout who started the rumor, he bought shares right before he told everyone about the herd. Then he sold at the peak. He made a killing. He never touched a spear. This is called speculation. And it's not a bug, it's the main activity. Third, escalation. Some hunters are better at this than others. There's a guy in your tribe who doesn't hunt at all. He just watches who's buying and selling shares, tracks patterns, and makes predictions. He notices that every spring, deer populations explode, so hunting stocks go up. Every winter, they crash. So he buys hunting shares in late winter, sells them in early spring, and repeats this forever. He's making more meat than the actual hunters. And the insane part? Everyone acts like this is normal. He's not creating value. He's not killing deer. He's just skimming profit off the volatility. But because he's good at it, people call him smart. They ask for his advice. They pay him stones to manage their shares. He becomes the richest guy in the tribe without contributing a single deer to the food supply. Fourth, escalation. Companies figure out they can manipulate their own stock price. You, the deer hunter, realize that if you just say you're going to kill more deer next quarter, your stock goes up, even if you don't actually do it. So you start making promises. You tell everyone you're going to kill 30 deer next moon. You've never killed more than 15. But the stock price jumps because people believe you. And here's where it gets really interesting. Your wealth isn't in the deer anymore. It's in the shares. You still own some shares in your own hunting operation. When the stock price goes up, you get richer on paper. So you have every incentive to keep making big promises, even if you can't deliver, because your net worth is tied to the stock price, not the actual deer production. And when you inevitably miss your target and kill only 12 deer, you just blame the weather, fire your assistant hunter, and promise 40 deer next quarter. The cycle continues. And shareholders, instead of bailing, often stick around because they've already lost so much, they're hoping for a comeback. This is called loss aversion, and it's why bad companies stay public for years. Let me give you a real scenario with numbers. 2021. A guy named Dave is scrolling through his phone and sees everyone talking about this company that makes electric trucks. The company is called Rivian. They've delivered about 150 trucks total. They're valued at $120 billion at their IPO. Dave thinks everyone wants electric trucks. This is going to be huge. He buys $10,000 worth of stock at about $172 per share. That's about 58 shares. Fast forward to 2023, Rivian has delivered about 24,000 vehicles total. They're losing about $33,000 on every vehicle they sell. The stock is at about $23. Dave's $10,000 is now worth about $1,334. He lost 86% of his investment. And here's the kicker. Rivian technically did what they said they would. They built trucks. They delivered them. The company didn't commit fraud. Dave just paid for expectations that were completely detached from the reality of manufacturing economics. He paid for the idea of infinite deer when the actual herd was tiny and the cost of each hunt was unsustainable. The stock market priced in a fantasy, and when reality showed up, the price corrected. Dave wasn't scammed by criminals. He was scammed by his own optimism and a system that rewards hype over fundamentals. Now you're asking yourself, if this system is so broken, why does anyone participate? 2 reasons. First, because sometimes it works. If Dave had bought Apple stock in 2003 and held it, he'd be up about 50,000%. The system occasionally produces massive winners, and humans are wired to focus on outliers. We remember the guy who got rich on Amazon stock. We forget the 1,000 guys who lost everything on pets.com. Second reason, and this is the real one, because you don't have a choice. Your retirement is in a 401k. Your 401k is invested in stocks. If you opt out of the stock market, you're opting out of retirement unless you're rich enough to self-fund. The system isn't designed for you to win. It's designed to be the only option. So you participate, you accept the volatility, and you hope that over 30 years, the upward trend outpaces the crashes. And historically, it does. The S&P 500 has returned about 10% annually over the last 50 years. But that average includes the guys who bought in 1970 and held through 1987, 2000, and 2008. Most people don't have that discipline. They panic sell at the bottom and buy back in at the top. They get slaughtered. So what's the actual takeaway here? 3 things. 1, understand that stock prices are not company value. They're collective opinion about future company value. The price of a share is just what someone else is willing to pay for it today. It can be completely irrational. In 1999, Pets.com went public at $11 a share. 9 months later, it was trading at 22 cents. The company didn't change, the collective opinion did. 2, dividends are the only real money. If a company pays you cash every quarter just for holding the stock, that's actual value being transferred to you. Everything else is just paper gains until you sell. A stock that goes up 50% but never pays dividends hasn't made you money. It's just made you feel richer. You're still holding the same share, you just think it's worth more. 3, the house always wins. Every time you buy or sell a stock, someone takes a cut. Your broker, the exchange, the market makers. High-frequency trading firms are skimming fractions of a penny off millions of trades per day. They made about $7.7 billion in 2024 doing this. They're not investing, they're taxing, and you're paying it every time you trade. Here's the brutal truth. The stock market isn't designed to make you rich. It's designed to make you participate. It funnels your savings into a system where the professionals have faster information, better tools, and legal permission to front-run your trades. Your 401k goes into index funds that auto-buy stocks, creating constant demand that props up prices regardless of fundamentals. And when the market crashes, which it does every decade or so, regular people lose jobs and homes, while the professionals get bailouts and bonuses. I'm not saying don't invest. I'm saying understand what you're buying. You're not buying a piece of a company. You're buying a claim on future cash flows that may or may not materialize, priced by a crowd that's mostly guessing, in a market designed to extract fees at every step. Stocks are formalized meat sharing. And just like in the cave, the guys who own the most shares didn't get them by hunting. They got them by being there first, knowing the right people, or convincing you to give them your stones. The spear you bought with your 5 stones, that's still out there killing deer. You're just not holding it anymore. This is a simplified cave story to explain a modern system.